Silver just printed $80, pulled back, and then China's only pure silver fund hit the circuit breaker on the way down. That's not just volatility. That's the market showing you the plumbing is clogged. This is our room, our community, and our job is to watch the pipes before the flood hits the living room. Here's the trap they want you to fall into. Stare at the pullback, call it a top, and walk away, because if you do that, you miss the real signal. The real signal isn't the number on the screen, it's the panic inside the paper wrappers that are supposed to represent metal. Let's get specific about what actually happened. Over the last 72 hours, silver punched through $80 an ounce on the big modern exchanges. First time that level has ever been printed in the era where most trading is electronic and leveraged and fast, then price retreated. And right after that, in China, where physical demand is not a hobby, it's an industry, there was a 10% one-day drop in the only dedicated silver investment vehicle most domestic investors can access. Not a normal 10%, a max limit 10%. The kind of move that slams the emergency brakes and forces the exchange to stop the bleeding because the selling pressure is too hot. Now watch what makes this even stranger. The manager of that fund didn't just ride it out quietly, they went public with a warning. They told investors the gains had become unsustainable. They capped subscriptions. They tightened the gate while the crowd was still running toward the entrance. When the person collecting fees for inflows starts turning people away, the story changes, not because they suddenly found religion, because they're signaling stress. They're signaling they can't keep the promise the wrapper implies. And this is where we need to separate fact from interpretation, like adults. Fact: silver hit $80 and backed off. Fact: the Chinese fund fell 10% in a single session and triggered the daily limit. Fact: the fund traded at a massive premium to the underlying futures exposure. Fact: management responded by limiting new inflows and issuing cautionary language. Interpretation: the paper structure is bending because real demand is pressuring a system built for infinite paper supply. This is educational. We manage risk. Now, why does China matter so much here? Because in that market, access is bottlenecked. If you're a Chinese saver and you want silver exposure without stacking bars under your bed, you don't have a buffet of products. You have a narrow door. When excitement rises, it doesn't spread across 20 tickers. It concentrates. It piles into one vehicle. That concentration turns normal sentiment into pressure, and pressure turns into price distortions. And those distortions are the first place the truth leaks out. The fund had been ripping, triple-digit gains, the kind of run that makes people talk like they discovered gravity. And as it surged, something else surged even faster. The premium investors were willing to pay over the fund's underlying exposure. Now let's pause here, because this is one of those moments that separates watchers from players. A premium is not extra value. A premium is desperation. It's the crowd saying, I don't care what the metal is worth, I just need a ticket. At the start of the month, the premium was already elevated, not catastrophic, elevated. Then it expanded, and expanded, and expanded, until at the peak, investors were paying roughly 60+% above the value implied by the fund's futures holdings. 60+%. That's not a frothy market. That's a broken hinge. In a clean market, that premium gets crushed by arbitrage. Pros step in. They sell the expensive wrapper. They buy the cheap underlying. They harvest the spread. The premium collapses back toward reality. So here's the question that should bother you. If this premium got that extreme, why didn't the arbitrage machine flatten it? Because the arbitrage machine needs metal confidence to function. It needs liquidity. It needs the belief that paper can reliably translate into exposure without getting trapped. And when the market starts doubting that, when it starts suspecting that paper promises may be settled in cash, delayed, rationed, or relabeled, then risk-free arbitrage becomes a career-ending bet. That's the point. The premium isn't just a Chinese curiosity, it's a stress test result. Now watch the next layer. Management didn't just say, be careful, and leave it there. They changed the rules in a way that targets short-term flows. They tightened subscriptions on the share class used by fast money. They reduced how much new cash could come in dramatically. Translation: we can't take this many people through this door without the door breaking. If you've ever watched a crowded venue, you've seen this. When a crowd surges, security doesn't open more lanes. They close gates, they slow the stampede. Not because they hate customers, because the stampede kills the business. Now the skeptics will jump in right here and say, bubble. They'll point at a 10% down day and say the party's over. But here's the mistake most people make. They treat a paper wrapper's volatility as the metal's truth. What happened before that down day? The fund hit limit up repeatedly. Moved so strong, the exchange had to cap how high it could go in a session. That's not weak hands, that's pressure. Then it snapped back. That's not proof the whole story is false. That's proof the system is stressed. And stress does not guarantee direction tomorrow morning. Stress tells you the range of outcomes is widening. So how do we think about this without getting hypnotized by candles? We zoom out and we ask the ugly question. What is the market actually paying for, growth or access? Because this isn't just a silver story, it's an access story. If the screen price is $80 and real-world acquisition costs are higher, premiums, delays, rationing, then the screen is a headline, not a clearing price. Now we step into the fundamental engine and we keep it simple but not dumb. Silver is not just jewelry. It is wiring, contacts, paste, heat flow, and reliability. It's the metal that makes electrons behave. Solar is a major eater. Panels need silver paste for contacts. That's not a marketing preference, that's physics. The industry has tested substitutions. Copper looks good on paper until corrosion and efficiency show up with a baseball bat. Electric vehicles add another bite. More sensors, more power electronics, more high current pathways, more connections. EVs don't just replace an engine, they replace the entire electrical architecture of a car with something more demanding. And then there's the new wildcard that keeps sneaking into demand curves, AI. Not because a chatbot needs silver, because servers need density, cooling needs reliability, and power distribution in data centers needs components that don't fail under load. Scale that across a world-building data centers like it's a war effort, and you get a quiet and relentless pull on the same industrial inputs. Add consumer electronics, medical devices, industrial controls, and you start seeing the pattern. Silver demand isn't one big wave. It's many rivers feeding one lake. Now, supply. Here's the part no one likes because it ruins the miners will respond fairy tale. Silver is mostly a byproduct. It comes out of other mines, copper, lead, zinc, gold. That means silver supply doesn't ramp just because silver is expensive. It ramps when other metals justify new projects. So if we're wrong, where will it show first? It will show in inventories and premiums. And that's why inventories matter more than price when the market is stressed. When inventories are high, paper can play games because there's a buffer. When inventories are low, paper games become dangerous because any demand shock pulls against empty shelves. The market has been running deficits, demand outpacing supply, not for a cute quarter, for years. That deficit is paid out of above-ground stockpiles, vaults, warehouses, ETFs, industrial buffers. And here's the brutal truth. Those buffers can shrink quietly until one day they don't exist. When the buffer is gone, the market doesn't rebalance. It rations. Price is the rationing mechanism. That's why the Chinese premium matters. It's rationing showing up early. Now let's talk about why the media narrative is so often useless right here. They'll frame this as silver spiked, then corrected. They'll mention a fund crash and call it profit taking. That's like watching smoke pour out of a kitchen and saying, the chef is experimenting. The interesting part isn't the pullback. The interesting part is that the crowd was willing to pay 60+% extra just to get exposure. That's not greed alone. That's a signal of perceived scarcity and limited access. Now we need to address the other elephant. Paper silver is a casino with rules that can change mid-hand. Exchanges can raise margins. Funds can halt subscriptions. Brokers can restrict buying. Contracts can settle in cash. That's not conspiracy. That's how systems protect themselves when they're stressed. So if you're holding paper exposure, your risk is not just price direction. It's rule risk. If you're holding physical, your risk is storage and patience. Different game. We're not here to preach one lifestyle. We're here to understand the battlefield. And the battlefield right now is split in two. One side is the screen price. The other side is the real-world cost of access. When those two diverge, something has to give. Either the screen price rises to meet reality, or the premium collapses because the wrapper is discredited, or the market finds a new rule set that forces one side to cash settle and the other side to ration metal. That's why calling this a bubble is too simple. A bubble is when price detaches from reality because belief outruns utility. This looks different. This looks like utility outrunning supply and paper trying to pretend it can stretch. Here's what the premium is really doing. It's acting like a thermometer in a room where the official thermostat has been hacked. The screen can say 75, 80, 78, whatever it wants. The premium tells you how hot the room actually feels to the people trying to get exposure right now. This is where the chain reaction starts. Stage 1, investors chase the wrapper because it's the fastest door. Stage 2, the wrapper can't expand cleanly, so the premium balloons. Stage 3, the manager clamps the door, which pushes frustrated demand into the next available door. Futures, OTC products, dealer inventory. Stage 4, spreads widen. Delivery times stretch. Out of stock, banners multiply. Stage 5, the market stops talking about price and starts talking about terms. Cash settlement, delayed delivery, limits, exceptions. Fine print. That's the moment a lot of people freeze because the game is no longer buy low, sell high. The game becomes, can you even get it when you want it? Now watch the psychological trick. They will flash a red day and tell you the squeeze is over. But if the constraints are real, red days don't end the story. They reset the leverage. They flush the tourists. They hand the metal to the patient. So don't anchor on one candle. Anchor on the behavior of the bottlenecks. Because bottlenecks don't care about your opinion. They care about throughput. If the bottleneck tightens again, the premium will tell you before the headlines do every time. Now, history. People love dragging out 1980 like it's a magic spell. Hunt Brothers, crash, the end. Yes, silver has seen manias. Yes, rules changed. Yes, people got destroyed. But watch the key distinction. Back then, you had a concentrated attempt to corner a market with financial leverage. Today, you have broad industrial demand pulling on a supply chain that can't sprint. Speculators can leave. Industries cannot. A solar manufacturer doesn't say, the chart looks overbought, let's cancel production. They have contracts, they have targets, they have national policy backing their build-out. An automaker doesn't say, RSI is high, let's stop building. They have factories, labor, and deadlines. That doesn't mean price only goes up. It means demand is stickier than the headline traders think. Now layer in policy and macro. When rates fall, the opportunity cost of holding metal falls. When currencies wobble, hard assets become a psychological anchor. When geopolitics heats up, people reach for what governments can't print on a whim. You saw a high-profile industrial voice react bluntly to export restrictions. Not good. That matters because it's a peek into boardroom anxiety. Not a trading tip, a mood signal. And mood signals matter when supply chains are tight. So what do we do with all this without turning into chart addicts? We build a framework. First, we accept that short-term volatility is not a bug. It's how stressed markets breathe. You will see violent up days and violent down days. They will try to make you nauseous. Second, we stop confusing the wrapper with a gift. A fund can swing 10% because its shareholders are panicking. The metal doesn't teleport. Third, we watch the telltales that expose real tightness. Premiums, delivery times, inventory reports, and the behavior of gatekeepers. When a gatekeeper caps inflows, that's a signal. When premiums blow out, that's a signal. When inventories trend down and don't recover, that's a signal. Now, here's a contradiction that should keep you glued to the next developments. If silver just hit a historic top and the story is over, why are access premiums still elevated? Why are managers restricting subscriptions? Why does the market keep producing these distortions? That's the crack in the bearish argument. And here's the crack in the bullish argument too. A 62% premium is not a stable equilibrium. It's an alarm bell. It can compress fast and hurt anyone who chased it blindly. So our stance has to be disciplined. We don't worship the metal, we measure. If price pulls back hard, we don't panic. We ask, did the physical market loosen or did paper just flush leverage? If price rips higher again, we don't FOMO. We ask, are we paying for value or are we paying for crowd emotion? This is how we stay sane while everyone else is either euphoric or terrified. Now you might be thinking, okay, where does this go? No fake confidence. We can't promise a number. Anyone who tells you it will definitely hit X is selling certainty they don't own. But we can say this, if deficits persist and inventories don't rebuild, the upside case strengthens, because the market must either ration demand or attract new supply. And attracting new supply takes time, years, which means price has to do the heavy lifting. That's why $80 matters, not because it's magical, because it's a line that tells you the market is willing to print uncomfortable numbers when the pressure builds, and pressure is building. Now let's make this personal, because that's where retention lives. They want you exhausted, they want you to watch 10 charts, read 50 tweets, and end up doing nothing. Or worse, doing something impulsive, so we keep it simple. We focus on a few key takeaways and we go deeper, not wider. 1, the $80 print plus the immediate stress response in China tells us this isn't a sleepy market anymore. 2, the premium blowout tells us access is becoming the product, not just price. 3, supply is slow and demand is layered, which makes the system vulnerable to shocks. 4, paper vehicles can move violently because the rules can change, so risk management matters more than bravery. That's enough. Everything else is noise. Now, here's where we bring you into the process. What would make you change your mind first? A price drop on the screen or a sudden rebuild in inventories? And if you had to pick one signal to watch, premiums, inventory levels, or fund restrictions, what are we watching together? Drop your answer in the comments. We read them and they shape what we dig into next. And if you want us tracking these pressure points in real time, hit subscribe. Short, simple. Stay with us. Now, the next move is where people get tricked, because after a historic print, the market loves to punish late buyers and scare early holders. It will whip, it will snap, it will fake both directions. So watch this carefully. If we see premiums stay elevated while price dips, that suggests paper selling, not physical relief. If we see premiums collapse and inventories rebuild, that suggests real loosening. And if we see more gates closing, more caps, more restrictions, that's the market admitting it can't absorb the demand without breaking. That's when the story changes from price discovery to allocation. And allocation is where the quiet moves happen behind the scenes. Industries don't tweet, they sign contracts, they lock supply, they secure inputs. And when they do, the public usually finds out after the easy metal is already spoken for. So the real cliffhanger isn't whether silver bounces tomorrow. The cliffhanger is whether the next restriction hits the paper market or the physical market first. Because whichever side gets rationed first tells you where the true scarcity is being felt. And if we're seeing 60+% premiums in a major market today, we're already getting a hint. Keep your eyes on the gates, because when the gates start closing, the screen price becomes the least interesting part of the story.